So in 2025, something huge is happening. Crypto is finally converging with mainstream finance. And look, this isn't some far off prediction anymore, it's happening right now. In this explainer, we're going to break down exactly how regulation, big money institutional adoption, and some brand new tech are all colliding to shape the future of this entire asset class. Welcome to Chain Bureau, where we provide smart crypto insights for smart investors. Let's dive right in. You know, the single biggest catalyst for all this? It's a massive seismic shift in U.S. policy. As State Street points out right here, the new administration is making regulatory clarity a top priority. And that one simple fact? It's unlocking the floodgates for serious institutional investment. So here's what we're going to cover. First, we'll look at the new regulatory chapter that's really setting the stage. Then, we'll dig into why Ethereum is, well, becoming the institutional standard. After that, we'll explore the high-stakes scalability battleground. And finally, we'll get into the financial plumbing, the stablecoins and leverage that's powering this whole ecosystem. Okay, let's kick things off with that new regulatory chapter. Honestly, this is the foundation for everything else because, let's be real, without clear rules, the big institutional money is always going to stay on the sidelines. And wow, the change has been incredibly swift. Right after the election, the new administration moved fast to set up a pro-growth policy for digital assets. But the most important move, the one that really changed the game, was getting rid of a rule known as SAB 121. So what was this SAB 121 thing anyway? Well, it was a massive roadblock. This kind of obscure rule forced banks to hold their customers' crypto directly on their own balance sheets. And because of the huge capital requirements that came with that, it made it basically impossible for them to offer custody services. Getting rid of this rule was a total game changer, opening the door for the big, trusted, traditional banks to finally get into the crypto market at scale. All right, so now that we see how the regulatory fog is clearing up, let's do what we always do. Let's follow the money. Where is all this new institutional capital actually flowing? Well, the answer is becoming clearer by the day. It's Ethereum. A huge sign of this is the tokenization of real-world assets. We're talking about taking things like bonds, private credit, even real estate, and putting them right on the blockchain. And the fact that the RWA market on Ethereum is already worth $6 billion and climbing fast, it just shows that these institutions are serious about building their future right here. And it goes way beyond just RWAs. Ethereum is, quite simply, the backbone of the digital economy. It's the undisputed home of the two biggest stablecoins, and its battle-tested security and deep, unmatched liquidity make it the default settlement layer for any serious institutional player. And even in a down market for collectibles, just look at this. Ethereum is still the king of high-value digital assets. While its competitors are definitely making some noise, Ethereum continues to just dominate the NFT space, which reinforces its status as the premium network where real value accumulates. It's just not going anywhere. But here's the puzzle, right? Despite all this incredible adoption, Ethereum's price has been, well, kind of lagging. So what's going on? It could be that the value is flowing to the applications and the layer 2s instead of the main token. Or, hey, maybe the market is just slow to price in these huge fundamental shifts. It's the central question for investors right now. By the way, if you're finding this analysis insightful, please give this a like. It really helps the channel grow. And you know what? The answer to that puzzle lies right here in the scalability battleground. How Ethereum plans to grow and handle a global user base is really the key to unlocking its long-term value. There are really two competing philosophies on how to do this. You've got the monolithic approach championed by networks like Solana. Think of it like building a massive 16-lane superhighway. You just make the main chain itself incredibly fast. But Ethereum? It's chosen a modular path, which is more like adding a whole network of express lanes, we call them layer 2s, that handle all the fast traffic while relying on that main highway for its incredible security. And this table just brings the trade-offs to life, doesn't it? Look at Ethereum's base layer. Maximum security, but you're paying over $1 a transaction and only getting about 15 transactions per second. Then you have Solana, the speed demon, with thousands of transactions per second for fractions of a penny. And right in the middle, you've got layer 2s like Arbitrum, which offer a pretty happy medium. Super low fees and high speed, all while borrowing Ethereum's security. It's a classic case of risk versus reward. Arbitrum is a perfect example of how powerful this modular scaling is. It's the undisputed market leader in layer 2s, it's generating real revenue, and its DAO, that's a decentralized autonomous organization, controls a massive treasury to fund its own growth. For investors, it represents a powerful, leveraged bet on the entire future of Ethereum. Now, if you're looking for an edge in your own trading, we've partnered with VIP Indicators, which can give you some powerful tools. Check out the link in the bio. Okay, for our final section, let's look under the hood at the financial plumbing that makes all this institutional action possible. We're talking about stablecoins and on-chain leverage, the true lifeblood of the entire crypto ecosystem. At the core, you have stablecoins, and there's this kind of trilemma between trust, liquidity, and decentralization. USDC is the go-to choice for regulation and transparency since it's backed one-to-one with cash and treasuries. USDT is the undisputed king of global liquidity, even though its backing is a little more opaque. And then you have DAI, the decentralized, crypto-collateralized option governed entirely on-chain. Each one serves a really critical, distinct role in the market. And fueled by these stablecoins, the on-chain credit market is absolutely on fire. It has blown past the peak of the last bull market, hitting a new all-time high of over $73 billion. And this isn't retail FOMO, folks. This is sophisticated, institutional-grade leverage coming back in a huge way. What's really fascinating is where this leverage is coming from. Take a look at this chart. The majority of it is now transparent and sitting on-chain through DeFi apps. That's a massive shift from the last cycle, which was dominated by those opaque, centralized lenders that, eventually blew up. It's a clear sign the market is maturing. Hey, if you enjoyed this content, don't forget to drop a comment and subscribe. And for advanced trading tools that can give you up to 93% wins, check out the link in the bio. So, what's the bottom line here? The fundamentals of crypto have arguably never been stronger. We have the beginnings of real regulatory clarity, we have actual institutional adoption building on chain, and we have a much more transparent, mature leverage market. All the pieces of this great convergence are falling into place. The only question left is when will the valuation finally catch up to the reality of that adoption?